So we're going to hear from Kenneth, Masika. If you would like to go ahead and allow me to put you on the spot, Kenneth. Are you part of a family business? Because you come from a famous name in Kenya as far as real estate and property is concerned, or is it just a coincidence that you happen to be a director in a firm that bears the same name?
Thank you, Wangeshi. As always, it's a pleasure to be here. Let me echo Einstein's statements. I think we've all learned quite a lot today about investment. And yes, like you're saying, yes, it is true. My name is Kenneth Masika. I'm a property valuation surveyor by profession. And yes, the older Masika in Lloyd Masika happens to be my father. Yes.
Okay. But before you continue, I will point out, though, because we had the whole session, the whole conference today is about building wealth, right? And we had this whole bit around succession planning and wealth management in the morning. And the reason I bring that up is because one of the tensions that were spoken about today was how do you get the next generation interested, right? But and again, forgive me for putting you on the spot, but I think that it's also really important to point out that you are a trained valuer. You went to school for this. You're a graduate of Reading University. You've been doing this for a long time, and you didn't just get that directorship level because of patronage. It was something that you earned, and I think that that's also really important as we speak about asset management and we look at family businesses as a creator of that particular wealth, that in order for it to expand and to grow, that even if you do bring in family members, that they do come in and that they're qualified and able to do so. So enough about Kenneth on the personal side. We're going to talk to you today because you're the chair of the REIT Association of Kenya. And the REIT, as according to the Capital Markets Authority, which is the one that governs this particular asset class, REITs are defined as a collective investment scheme in real estate that is structured as a trust where an investor owns rights or interest in the form of units and earns returns from income or capital gains. The property is held by a trustee on behalf of unit holders and is professionally managed by a REIT manager. So that's a lot of jargon. Could the two of you please break it down for us in what it means and also how is that different from, how SACCOs own and build and sell real estate?
Okay, perhaps I'll give a background of sort of what REITs is, and then maybe Einstein can speak through running an active REIT and also being an asset manager. He also has a view to how SACCOs run their things. So maybe I'll start with talking about where the REIT market started, the types of REITs we have, the structure, the advantages of the REITs, and then maybe I'll stop there. So in terms of the Kenyan market, this kicked off in 2013 when CMA enacted what are called the REIT regulations. And in there is where the definition of a REIT is found. Those regulations also define the types of REITs that you can have in Kenya. We've got three main types: an income REIT, which invests in already existing assets that are generating income. You've got a development REIT, which as the name denotes, is a REIT set up for development. So they acquire parcels and then develop or acquire land that is due for redevelopment. Then you have a Sharia compliant REIT, which is basically a combination of the two, just that it's Sharia compliant with Sharia regulations. Easiest way to identify the REITs from each other is there's normally a letter before the word REIT, and that will define which one it is. Like Fahari has got an I, which means an income REIT. A D REIT will have a D, and the Sharia REIT an S. In terms of structure, it is very simple. If you can just picture a cross, right, with sort of your horizontal and perpendicular. Where they meet, that's where the REIT entity sits. On the bottom of it, you've got the properties, which generate now rental income and income into the REIT. On the top, you've got the unit holders or shareholders, who put in their money into the REIT to enable the REIT acquire the assets, and in return, they get their dividends. On the left-hand side, you've got your REIT manager, He performs, or they perform, the functions of running the REIT on a day-to-day basis. And that's what, like in the case of Fahari, that's what ICA Lion does. On the right-hand side, you've got the trustee, who really performs the roles of an oversight and a custodian. You'll find the assets that are owned by the REIT actually do not sit in the REIT. They're actually held in trust by the trustee, and the trustee also keeps an eye on what the REIT manager does. And if you look at the regulations, it is very extensive in the roles and requirements for each of the parties and what they do and what they cannot do, and how you onboard them and how you get them off. So the regulations are really, really well structured. What is the advantages of investing in a REIT? There are 7 main ones, and I think I'll just go through this quite quickly. There is diversification. It enables you to invest by buying into a REIT. It enables you to get a small share in a REIT that has invested in retail, light industrial, commercial real estate, shopping centers, and the like of it, which is very difficult or quite expensive for individual owners to invest in. REITs are transparent by the nature of the regulations. There are very high reporting standards that REITs have to adhere to. They are regulated as well, which is one of the key things that people tend to miss out when you read the REIT definition. It is a regulated scheme. So CMA has an oversight into it. Due to their tax advantages, there is sort of a dotted reporting line to KRA, and the trustee keeps an eye on it as well. So there is governance and regulatory accessibility. If you look at Fahari, they invest, and I keep giving Fahari as an excuse that for a long time they've been the listed REIT in Kenya. They invest, they've got a mall, they've got some light industrial, commercial properties out in industrial area. If you look at their market capitalization, accessibility means you just buy shares in it. So you don't need to be going to the bank to get a big loan to acquire the shares. So in political jargon, it makes it accessible to Wanjiku. Liquidity, the shares are traded on the NSE, so you can buy as many as you want, you can sell when you want. So entry and exit is quite easy, and that is actually one of the major advantages of REITs. We all know that property takes quite a bit of time to acquire and onboard, and selling as well does take quite some time, especially now given where the market is. Those timelines have just extended. It is also provides guaranteed steady returns. In terms of REITs, and especially income REITs, you tend to find the returns are based on leases. Now, we all know how leases work. You get a client in, being commercial property, it will normally be a 6-year lease with an escalation every 2 years. And so you can see where your income is coming from. Then in terms of returns, by the regulation, REITs, to maintain their tax-free status, must pay out a minimum of 80% of their profits every year by law, without exception. So that guarantees you an income every year, provided they make a profit, which they do. And then the biggest and the final one is the tax advantages that are encased in the REIT structure. When a REIT acquires an asset, number one, if it's a commercial asset, they're VAT exempt. They do not pay VAT on commercial assets. In terms of the money, if you remember the structure that I gave, you've got the properties lying at the bottom with the income flowing into the REIT. When that income moves from the property into the REIT, that is exempt from corporation tax. And also when the dividends is paid out, it's exempt from tax with the exemption of withholding tax. That's payable. So unlike you holding your own property, especially with what a lot of Kenyans tend to do is you'll create a company that then holds the property and you as a shareholder. So you'll find the company will pay a tax on the income they get. And if you as the shareholder draw a dividend or declare a dividend from that income, you again pay a tax. So you can see there's a huge tax advantage in that. And finally, when a REIT does sell a property, they are exempt from capital gains tax, which you know has been quite a big challenge to sort of private property investors when they come to sell. It does impact your return. So that's the basis of it in terms of structure and advantages. In terms of what has happened since the regulations were enacted in 2015, we had Fahari as the inaugural listed REIT on the NSC. Then in end of 2017, in November, the REIT Association came into being. The association's main role is basically growing the REIT space, which we attempt to do by market education, by lobbying, to make sure that we keep the incentives and the advantages that we have in the REIT structure and grow them. We also try to be a one-stop shop for anybody with any questions, queries, thinking about registering a REIT. At least now there's somewhere, I think like you rightly said, everybody thinks it's a very complicated thing, but it's simple at the basis of it. But at least now you know the REIT association is there. We do not hold shares or anything in any particular REIT, so we are independent. And we provide any information that anybody looking to get into the market is looking at. And then in 2021, we had Aecon come through with their income. They have an income REIT and a development REIT. So that has been the activity that has been going on in the Kenyan REIT market. I think for the people who are here investing, we do know that there are other countries in Africa that have REIT markets that are starting, but in most African countries, they're still in the nascent beginning of things. They're not as advanced as Europe and the US, which has been in the REIT sector for almost 60 years. And I think one thing to bear in mind is, I think like Sandeep said, property is a long-term investment. And then that's one thing that always needs to be borne in mind. I think people tend to look at REITs and say, hang on, this thing is not performing like Safaricom. But if you ask somebody, if you develop your property, you know what you bought it for, you develop it, you don't expect to sell it in another month or 3 months or 6 months for 10% profit. What you know is that you'll get income from it, and over a period of time, it will appreciate. So I think I'll stop there. I think that sort of gives a ballpark view of the theory around it. Maybe I will let my senior speak to the sitting in the hot seat and driving one.